topic we are going to discuss is investing through accounting ratios. So how we can use accounting ratios to do investment and to screen the stocks, and based on evidence and data, we can validate whether we should go with certain companies or not. So that's why I have taken this topic for today's discussion, today's class, so that it is relevant for all, because everybody is going to do investment after they get the placements. So that's why this topic. So why ratio analysis? Ratio analysis is the mechanism of gaining insight into company's capital allocation, liquidity, operational efficiency and profitability. Or capital allocation is what type of capital structure should we follow? Should we go for more debt, more equity, or only debt, only equity, or convertible bonds? So these are the capital allocation decisions which we can take from ratio analysis, like debt equity ratio. We can use that. EPS, earning per share. So that way we can do. Liquidity is whether the company is liquid. For example, real estate businesses are not liquid. They sell their flats, apartments a bit late, so their operating cycle is very long, and their liquidity is very low. The ratio is very low. In comparison to FMCG companies and perishable goods they have a high liquidity. Every day we purchase milk, so the ratio in that way is very high. Current ratio, asset ratio, and asset test. The third is operational efficiency. What is the efficiency of the company in terms of return on asset, return on equity, return on capital employed, return on invested capital? These are the few ratios which we have learned in the term one. So this is the operational and profitability, net profit margin, gross profit margin. We compare this while we take investment decisions. And ratio analysis is also shows how the company is performing over time. We can compare each year and we can see whether the operating profit margin is increasing, return on asset is increasing year-wise, and we can take a valid decision based on the data. And we can do a peer-to-peer analysis. We can compare the ratios of different companies in the same industry and see which company is doing better. And then we can use that use it to make a valid decision and good decision. And it also allows investors to evaluate the historical track record using various matrices. So next the mean, ratio analysis क्या क्या हो सकता है. So now we also use these matrices in cricket. Everybody has seen cricket and they see what is the strike rate. Normally the commentator they say what is the strike rate, what is the run rate, what is the batting average, bowling average, and these few ratios. These ratios are important because through these ratios we see that whether the batsman or the bowler, we see whether how is the consistency. If the batsman has a good batting ratio, good return on good strike rate, so we can say that in the coming matches also he will perform well. So we validate it. So that's why in the commentary we see that the commentators talk about these ratios. Then again the thing is that some performances are not very good. So 21 बॉल में सिर्फ 11 रन बनाने वाले को जनता माफ नहीं करती. And then there is a famous quote of Howard Marks: "Never forget the 6-foot tall man who drowned crossing the stream that was 5 feet deep on average." It is very important because sometimes what happens if you cross a river which is very shallow, there may be only that may be not deep, but there are certain points which are very deep. So we should use even in that crossing the river, we use the ratio. So on average it is very shallow, but there are certain points which we have to see and which we can track even through ratios which points we have to go left, leave and move forward. Now the classes of ratios which we have already talked in the term one. Ratios are divided into 4 classes: activity ratios, liquidity ratios, solvency ratios and profitability ratios, which I already talked in the first slide. The activity ratios are inventory turnover ratio, receivable turnover ratio, payable turnover, working capital, asset turnover. The liquidity I already talked about the current ratio, quick ratio, cash conversion, how the company quickly is converting the cash, whether the company is generating the income which the company is generating, whether it is converted into cash quickly or not, and how quickly it is converted. If it is a perishable company and it is not converting the cash quickly, it is a red sign, red alert. Then the solvency ratio is that debt to EBITDA, interest coverage, how much how much is the profit, operating profit covering the interest cost, how much times. And then the profitability and capital allocation ratio are also there. Gross profit margin, operating profit margin, net profit margin, return on assets, return on equity, and return on capital. And there are also many other issues which we haven't studied. Few will discuss in today's class. So for taking your time into consideration, which is very important, and you are not here to study the same things which we have studied in term 1, I will not discuss those ratios. I will discuss some new and different ratios which are very important, which I use when I do investment decisions, and which I would suggest you to use when you do investment decisions. The first is CFO by EBITDA. CFO by EBITDA is both of the numerator and denominator, which is CFO and EBITDA, both are operating related to the operations of the businesses, and it reflects whether operating profit is converting into real cash or not. So why it is important? It is important because if we see that whatever the operating profit the company is generating, whether the company is able to convert it into cash or not. If the company is not able to convert it, that means there is the operations are not good, and there is a red sign that companies can be doing earnings receivable management. So that's why CFO and EBITDA is very important. So I have included a peer comparison whereby we can see the information technology, IT-enabled services companies. We can see that the CFO by EBITDA of all the 6 companies are very good. But when we compare it with the peer network technologies, we can see that it is negative. So this way we can filter out the company which we don't have to invest. So there is a possibility that we are not considering this ratio and we invest in this company. However, when going forward after few months and after some time has passed, we see that the company is not generating, the share price is not increasing. This is the reason why it is not increasing, because they are indulging bad practices, receivables management, which leads to a low CFO by EBITDA ratio. But there is an ambiguity if we take only EBITDA as the denominator. Why it is an ambiguity? Because there may be certain companies which are not having rent. For example, DMart. DMart owns the property in which it is doing business. So it doesn't have the component of rent. It is not paying rent. So it is not subtracted from EBITDA. So we cannot compare apples with apples. That means certain companies like DMart, it leases property, so it pays rent. However, then there is another company, DMart. It owns the property, so it is not paying rent. So it is getting an added advantage of not paying rent, and its CFO by EBITDA ratio is higher. But compare apples with apples and DMart with DMart. We have to include the rent component in the denominator so that we get a fair view and we take our investment decision judiciously so that we invest properly. And that's why we include rent and we make a new ratio CFO by EBITDA by including rent in the denominator. Now going to the next ratio, I talked about doing management, doing receivables management. We can do earnings manipulation. So we normally when we invest, we see the net income and the earnings per share of the companies. However, that is not only the main thing which we have to see when we value a company and when we take our investment decisions. We have to see whether the company is able to generate the get back the cash, and what is the receivables management, how it is doing it, whether they are creating fake bills or to increase the receivables and to show that we have generated a high revenue year by year. So that's why we do receivables, we check receivables management, and we benchmark the receivables day with competitors and peers to see how the competitors are doing the same in their industry, whether the ratio of all the companies in the same industry are same, or there is ambiguity in certain companies. So then there is another case study whereby I have taken the dairy industry that is in the perishable goods industry, and there, as you know, dairy industry, we purchase milk every day, we pay to the person through which we are purchasing milk. So we can see that in these three companies, the receivable debtors day is very low. When you see, however, in comparison to Quality Limited, the debtors day is very high. It's like saying that I am buying milk today, I will pay after 3 months. No, but it doesn't happen in real life. So that's how you can check through clear comparison whether in receivables management they are indulging in receivables management or not. So we can see that Quality Limited was indulging in receivables management, and that's why it was delisted from stock exchange. Next, coming to the assets turnover ratio. I have a question. Which ratio to select? Net asset turnover ratio or gross asset turnover ratio? Net. Net. So there you are wrong. We don't have to select net asset turnover ratio. I'll say why. When assets are depreciated, the net asset value, that is the denominator, changes, and the sales are same in both the ratios when we take gross as well as net. So when the net assets decreases, the denominator decreases, and that inflates our ratio. We can see the example. There is a sale of 1,000 crores. There is a gross assets of 500 crores, but when we depreciate it, there is a net assets of 200 crores. So we can see the difference in both the ratios, net as well as gross. So net assets show a very good ratio of 5, and gross asset turnover show not a good ratio and below 5. So however, when capex is done, this net assets, when the net assets ratio decreases, net asset turnover ratio decreases. When we do capex, we invest more in, purchase more fixed assets. So that time our denominator increases suddenly, and that time our turnover decreases from 5 to 2 because we have added up new assets, and that's why our ratio decreases. But then this is also not good. Why we take gross asset turnover ratio is important. Because in gross asset turnover ratio, we don't consider the depreciation aspect. We only consider the sales as well as the total assets which the company has purchased till now. So that is a fair view. What is the total amount of assets which the company has purchased, and compare it with the sales. So we can see that when we take average net block and average gross block, we can see that K and Agri, there is a high difference, as you can see. So we can see that the agri resource ratio of sales by net assets is increasing just because they have high depreciation. They have charged high depreciation to previous sales. However, when we consider cross block, we see that it is not that high. So we can remove this company and take a judicious decision based on our data. Next, coming to the third ratio of closing stock inventory by sales. We do this ratio. This ratio is very important because it's when we do the profit and loss analysis, we take the closing stock. And we subtract it from the sales. The closing stock is very high and it's different in comparison to the peers. We can see that there is an earnings management done. So this is another case study whereby we can see that it is all the companies have a closing stock by sales of 0.01 to 0.06. It's very low. But when we see another company, Family Care, we see that the closing stock by inventory is very high. That means they are inflating their revenue and the operating profit by increasing their closing stock. That means it is 9.63 and it is a red flag. We have to, when we take our investment decision, we have to see why it is very high. We have to see the con calls whereby the management discusses and why it is very high. If it does not justify why it is very high, we have to not invest in that company. Now coming to why it matters. Low closing stock by sales means company is able to convert stock into sales quickly. However, if high closing stock is there, that means that there is a stock pile up. In some cases, like the previous slide we saw, family care, there is a 9.63 which is a red flag suggesting that either aggressive revenue is there or bloated inventory is there. And we benchmark the ratios of all the companies and we do a peer-to-peer analysis. Why watching this ratio closely is very important. It helps with earning manipulation via inventory valuation. It checks aggressive revenue recognition and it is a cross verification tool with other ratios like debtor days and inventory days. Now the fourth ratio, return on incremental invested capital. How many of you have heard about this ratio? Return on incremental invested capital is the ratio of changing operating profit by changing invested capital. Like what is the return, extra return being generated by doing extra investment? That is the thing which the ratio tells about. The operating profit, change in operating profit is operating profit of this year minus change operating profit of last year. And change in invested capital is the invested capital this year minus invested capital last year. And this invested capital includes fixed assets, current assets minus current liabilities minus cash and cash equivalents. Because cash and cash equivalents are not invested in the business, it is sitting idle, it is not generating any return. Now peer-to-peer analysis, I have taken return on capital employed, return on invested capital and return on incremental invested capital. Whereby we can see that in the peer-to-peer comparison specialty chemicals industry, the return on invested capital is good, return on capital employed is good, and return on incremental invested capital of Pidilite industry is also good. However, when we see this industry, the Deepak Nitrate, fourth one, we see that the return on invested capital is good, return on capital employed is also good, but when we see the return on incremental invested capital, we see that they are generating a negative return on the extra invested capital they are doing. So that is a red flag. When they are not earning a positive return on the extra investment they are doing. So we see that it is not a good company to invest in if they are not generating a profit in the extra investment they are doing.
What do you mean by extra investment?
Like for example, every company does capex. So that is the extra investment. Capex is done for the growth of the company. If the company is not generating profit on the assets they are purchasing, that means the company is not doing efficient operations. So the recommendations as per ROIC is favorable. Pidilite and BASF has strong reinvestment efficiency, moderate for Gujarat Fluoro and Navin Fluoro, and unfavorable for Deepak Nitrate, Atul and Mil. The next example is of fast-moving consumer goods, whereby we can see again return on invested capital, return on capital employed, and ROIC. We see that for Gillette and Procter and Gamble, we see that it is very good. It is high for all the three. But when we see for example, Colgate, this one, it is negative in case of return on incremental invested capital. We say that Colgate is also not generating positive profit when they are doing in extra investment. However, a caution is again there in this ratio. There can be time lag. Suppose a company has done investment this year, so it is not possible to generate return this year. There might be a possibility that the return will come in the after years, 2 or 3 years down the line. So that is the caution. We have to see that whether the company has done investment this year or not. If the company has done new investment this year, we have to leave it. Okay, the ratio can be negative because new investments are done this year. The second is depressed ROIC after capex, which I already discussed. And then there is a J effect. Like if we do investment this year, in the first year it will be obviously negative, so it will be down. However, it will increase with time and that it will create a J curve. That is the J effect. Back to basics, जमीन से जुड़े रहना चाहिए. So I will talk about income statement, warning signs. Everybody knows about income statement. I will be talking about revenue recognition, reporting bogus revenue, inflating income using one-off items, shifting expenses to later periods, and hiding expenses or loss and inventory management. First is revenue recognition plus bogus revenue recording. So this is the example of Media One Global Entertainment, whereby we can see that in the quarter of June 2024, they reported a positive sales of 22.02 crores. However, when coming to the end of the year, March 2025, there is a negative sales of minus 22 crores. That means the revenue which is sold at the starting of the year, it returns back because the receivables and all the things which were sent is not converted into cash, and they have to show it as a negative. Next is inflating income using one-off items. Suppose we see that the profit, operating profit is this. However, when we compare it with net profit, we see that in this year the operating profit is 116 crores. However, the net profit is 340. Now, how is that possible? So when we see the income statement, we see that the other income is 358 crores, which is not the general operating process of operating, not the business of the company to generate income from other sources, other income sources. So it is again a red flag. Again in March 2025, they are having other income of 721 crores, which inflate the net profit, which is the bottom line. So we have to be careful when we do investment using net profit. We have to compare operating profit with net profit and see whether the company is inflating the profit, net profit, through other income sources or not. Everybody knows about the Satyam scam and how it indulged into shifting expenses.
When you come into the market, you can say a small investor or a new investor, he looks for EPS. He's very much fascinated about EPS. So what is the EPS and what is the P ratio and all. And when you grow with time, then you look for the top line. You forget about the EPS. EPS grows, EPS comes down. What is the top line of this company? That is more fascinating ratio, you can call it. And after that, actually, you are looking for the concept. What is the concept in the product? Is it innovative or not? It has a moat or not? It is competitive or not? Then, or this concept will work or not? So this is what you begin your
natural progression,
right? So nowadays, actually, what I am thinking, as you said, even now, what I am thinking that can I be a part of this company for 30 years or not? This is what actually nowadays I am asking myself. Would I be able to remain with this product, with this company, till I live?
We saw the video and we discussed throughout the session about accounting ratios and how we do investment using this accounting ratio. So we saw that even in the video, Vijay Kedia sir, who is an ace investor in India, who told that investing is not so easy. It is not a child's play. In real life, anything is not very easy. So become an educated investor, become a vigilant investor, become an investor who does investing on the basis of evidence data. It's not that simple. So my point is, those ratios are important. Those ratios will help you remove companies which are not that profitable. So always use accounting ratios, but there are other things which are also important. Like for example, what is the moat of the company? Whether the company is having a good product, whether the product is useful for the consumers, whether the consumers are benefiting or from the products they are using, and whether the products is innovative. So these are the factors which we have to consider. We just don't go with the flow, with the herd behavior. Like everybody is investing in a particular company, so we will invest. That is not the way of investing. That is not smart investing. Become a smart investor. Become an educated investor. So always think about what is the moat of the company, what is the product, how much research and development expenditure is the company doing, whether the product is useful for you or not. Think from the owner's perspective. Think that you are the owner of the company. Just don't think that
you are a consumer of the company. Think from the owner's perspective. If you are an owner of a company, whether you will invest in that company or not, or you want to become an owner of the company, whether you will invest in that company or not. Think from that perspective. Think from the owner perspective, not from a consumer perspective. Thank you.